Active funder, investment funder individually selects securities to be the intended market index or benchmark. Active funder, directly managed by manager or team of managers, fund manager. Their role is to outperform the benchmark and to give the investors a higher alpha or a higher return than the benchmark. Fund manager enjoy a variety of strategies to construct and manage a portfolio. They have the choice. Less transparent with the higher turnover. They buy, sell, buy, sell. They don't tell you what I'm buying, what I'm selling. High tax liability, STT goes higher, transaction costs go higher. Outperform the benchmark index of market average. Performance highly depends on the scale and decision-making ability. Suppose I have to choose 50 stocks out of the large cap, which are 100. The funding ability, team's ability, which will outperform, which bank will outperform, which other sector, which I should go heavy. A lot depends on fund manager. Let's actively manage it. Security is selected after extensive security analysis and research and market forecasts. Higher cost, manual fees, people are involved, high expense ratio, buying, selling. Most mutual funds except index and ETFs are actively managed. There can be equity, debt, hybrid, money, market, commodity, etc. ETFs. Nowadays, few ETFs can be actively managed. A few active ETFs also. Alternative. AIFs are gaining momentum. They are privately pooled investment vehicles that employ complex trading strategies. KFs include private equity, venture capital, etc. Smart beta, it can figure in both passive and active. Their non-conventional funding makes a benefit as a passively managed fund with a selection of active investment. The types of active investment strategies, bottom-up, selecting individual stocks based on their fundamental and growth potential. However the economy is, however the markets are. You feel the stock is good, this potential. It will rise, that's a bottom-up. Top-down, you look at the economy, then go downward. Analyzing macroeconomic factors, was the GDP, was the IAP, etc., the numbers. Then you decide, and trends to identify sectors and regions with favorable prospects. For rains were good, it was moving to agriculture, stocks might do well. Factors-based, exploiting systematic sources of risk and returns such as value, momentum, quality, and size. Activist, taking large stakes in underperforming companies and influencing management. Shorting, selling border security and arbitrage. Exploiting price differences with related securities of market. Suppose an A stock, price in BSE was 100, price in NSE was 102. We used to buy in BSE, sell in NSE, that's arbitrage. Leveraging, borrowing money for investment to amplify returns and risk. Please, as an individual, you should not borrow money and invest. Active funds, pros and cons. Potential to capture pricing opportunities and outperform the market. Fund manageability. He sees, oh, I'm in a diversified fund, large capital fund. I think the banks will do well. Let me go for that. Pros investors can reap benefits of professional management. Fund manager's role is coming. He's applying his mind. Which portfolio do well? Allows for more tailored investment approaches, including focusing on specific sectors, themes, or investment style. Automotive, gold theme, real estate theme, example, a diversified fund, mid-cap fund, etc. More flexibility to change allocation in response to adverse market events. Suppose he feels that the interest rates are not going anywhere, have to go low on the banking sector, he can reduce the exposure, which is not possible in passive. Cons. There is no guarantee of outperformance. Nobody can guarantee. It depends on the funder's ability and the market's performance. Maybe inconsistent. High operational cost results in high expense ratios. Buying, selling. Expense ratios because that's the expense ratio that's higher. More buying and selling of securities translates to higher capital gain distribution resulting in more taxable events. It cannot. Vulnerable to human bias like greed, fear, etc., leading to poor decisions such as bad timing, poor selection. Everybody is human. They can make mistakes. Active fund, the Indian story, just saying, over the years, the markets are growing more efficient. The hypothesis, driven by various regulatory reforms, driven by semi-law reforms, are coming along with enhanced transparency, increased participation, broader research alpha, education. People are becoming aware. As a result, it has become increasingly difficult to outperform the market. Actively managed funds usually perform better than their benchmark during bear market. It's just a research. It might not be always true compared to bull market. Large cap funds have lagged the most, particularly since the scheme recategorization. Different story. This recategorization restricted large cap funds from investing more than 20% of their portfolio in lower capitalization stocks. Share of active funds in mutual assets has dropped from 94 to 82. Key factors for actively managed funds: underperformance to their benchmark, narrow breadth of market performance. Second, fund with inability, blamed on the fund manager. Rationalization of mutual fund categories. Other factors. Key factors that increase the possibility of actually managing the fund out from the benchmark fund selection. Increasing investment horizon. The longer you remain, the better it is. Whether equity or debt, have a look at 1, 3, and 5. Performance underlying the market. Bull and bear phase. Other factors.